Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Phil Camporeale, Managing Director and Portfolio Manager on the J.P. Morgan Asset Management Multi-Asset Solutions Group. Phil, thank you for joining us today.
Sure, it's great to be here, Marianne.
Well, we're going to have an historic day tomorrow. So our listeners know that we're filming the day before President Trump is about to announce his official tariff policy, which is being called Liberation Day. I'm sure you're getting a lot of questions from your clients. What are you telling them about tariffs?
Sure. So first of all, it was one of the most well-telegraphed risks, if you listen to anything that the president said on the campaign trail. So people were worried about tariffs, and we're excited about other parts of the agenda that still can happen. That can include things like deregulation or fiscal policy, tax cuts, all that stuff, Marianne. But you're right, everyone's focused on tariffs right now. And I would say that the biggest tariff right now is the uncertainty tariff. Marianne, we hate saying that word. You hate saying that word. Uncertainty makes everybody kind of uncomfortable. And I think what it did for us is it took a little bit of the shine off U.S. exceptionalism. Remember, everybody was talking about that coming into this year. And U.S. exceptionalism takes three roles. The first is that the U.S. is growing faster than the rest of the world. The second is that our central bank, the Federal Reserve, as early as January, recently as January, was saying we can be patient. We don't need to cut rates anymore, while other parts of the world, like the European Central Bank, were cutting rates. And then the third piece of U.S. exceptionalism that we also got new information on this quarter was that we're the only ones willing to provide fiscal stimulus. And now what we're seeing around the world is, wait, there are other countries that can spend money on fiscal stimulus. So you take all those three things together, growth, rates, and fiscal policy. And what tariffs did was it, put a focus on the parts of the market that were priced to U.S. exceptionalism perfection, as I like to say. So the top 10 stocks in the U.S., Marianne, you know them, right? They attributed 76% of the return of the S&P in 2023, over half the return of the S&P last year. Those 7 stocks were at risk if, you started to take some of the shine off U.S. exceptionalism, which is exactly what happened. But as we get through tomorrow, and you're starting to see this week, I don't want to say buy the rumor, sell the fact, but the market has already adjusted.
It's priced
in because everyone, including the Federal Reserve and every Wall Street house, including us, have now taken down growth for 2025 from where we were coming into this year.
And then hopefully we'll have some more clarity.
Yes, exactly.
And we won't be sitting with all this uncertainty.
And I think that's right. I mean, companies, Jamie Dimon used to say this all the time about financial regulation and the last administration. He's not against financial regulation. He's against not knowing what those rules are and not being able to be agile and adjust to those rules. And I think that's what our companies are telling us now. They're on pause because they have to know what the rules are. And then once they know the rules, maybe they can adjust and pivot around those rules.
And that's just how markets function.
Yes.
They price it in almost pretty quickly. And
Very
I would say
efficiently.
and I would say a lot is already priced into the markets.
Yes, I would agree.
Okay, so let's go through the economy.
Sure.
Let's go through concerns about inflation. So what's your outlook, JP Morgan's outlook for the economy as we're seeing so many economists mark down their growth? Some are raising their percentage probability of a recession. Some of the numbers I've seen, at least right now, are around 35%. That is risk. I wouldn't say a tremendous amount of risk, but some risk. So where are you seeing the economy, at least at this point, not knowing what the tariffs are so far?
Yeah, and that's a really important question when it comes to what is the asset allocation because of that. So Marianne, we came into this year saying that the U.S. would grow above trend. In the U.S., trend growth, we believe, is 1.8% annualized. And we said that the U.S. economy was going to grow at 2.1 coming into this year. We've lowered that to 1.5. So we've gone from 2.1 to 1.5.
So you've gone from above trend
to below trend. That's right. However, stopping short of recession. I think it's way too premature to think about the U.S. economy having 2 consecutive quarters of negative GDP growth and 2 consecutive quarters of negative job creation, which, as you know, is the definition of a recession. And the key to this is U.S. economy was operating from a position of strength. And I think the administration knows that. We weren't teetering in the last quarter on recession.
No, we were growing very strongly.
Growing very strong, 3 handle on GDP. Also, position of strength on the S&P. 2 years in a row of the S&P delivering 25% returns. Position of strength for companies on margins. Margins are so important. Margins are very high right now. So if companies aren't, greedy and pass all of this tariff stuff on to the end consumer, the margins are a position of strength. And the labor market. We're sitting at about a 4% unemployment rate. We're creating jobs. And, initial jobless claims, which is my favorite measure of the labor market, is coming out every week. And while it's showing some layoffs in DC, Maryland, and Virginia, I wonder why they're not being kind of expressed aggregately across the private markets, across kind of the private sector. So you put all that together, and yes, we've downgraded our growth forecast because of the uncertainty. By the way, there's only bad news priced into that. We don't know what the good news of some of the promises from the campaign trail could be by the end of this year. But with the information we have now, 2.1 to 1.5. We've raised our recession probability from 15%, where we came into the year. That's the lowest we could have it. It doesn't get much lower than 15. We've raised that to 20%. So nowhere near the base case. And we have increased our inflation forecast from about 2.9 to 3.1. So you're sitting on all of this, and again, from above trend to below trend, but stopping well short of recession as the base case. And we think that has really important impacts for asset allocation.
So when I really just look at the numbers in isolation, it really doesn't look that bad.
Yeah.
And when I try to explain to investors, the U.S. is a very large economy. Mm-hmm. And as you pointed out, we had some very good momentum in terms of economic growth and where we were in employment. It takes a long time. We're like a ship in the ocean. Yes. You can't just quickly turn it. It takes a long time for that to filter through. Right. And I think that's one of the things that you were trying to say.
Right. And the key here, Marianne, does the pause as companies wait for the uncertainty turn into something more sinister? And we're not willing to make that jump just yet.
So the Federal Reserve, or the FOMC, recently had their meeting where Chair Powell talks to the press. Yeah. And he indicated that the Fed was in a good spot. Yeah. In other words, if they need to react, they can react. Yeah. What are you expecting from the Fed so far this year? What are you anticipating that the Fed might do this year?
Yeah, so one of the takeaways that we had from that meeting, Marianne, was that they stand ready to act in terms of bringing rates lower if the economy starts to slip, particularly the labor market. I think that's what you saw late last year when we got one maybe bad payroll report because of some hurricane maybe that triggered a SOM rule. And then next thing you know, they were cutting 50 basis points the meeting before an election. So we know what their trigger is. Their trigger is the labor market. And I think it was telling that you had a December summary of economic projection that increased inflation. And in March, they also said that inflation was going to be a little bit higher than expected. However, they stand ready to still cut rates. And I think at the end of the day, they're willing to stand behind the economy. I would just be a little bit careful in terms of saying, do you want the Federal Reserve to be cutting rates? Like, is there really a Fed put, as people like to say? And if the unemployment rate is going up and growth is falling and the Federal Reserve is cutting rates, I'm not sure, if the equity market is really going to like that just because the Federal Reserve is cutting rates. So from our perspective, we'd rather see them go twice than 3 times and maybe start in June and then maybe do something in the fall. And, I think that would be a lot more tame and less chaotic than them having to come in and cut rates a lot. We're not hoping that the Federal Reserve is cutting rates a lot this year, because if that's happening, I think the
something's bad.
Something is broken.
So part of your background is fixed income.
Yeah.
You know the fixed income market very well. Something that I don't get a chance to talk a lot about are the break-evens.
Yeah.
which I think are really important. I know the Fed really watches
Right.
the break-evens. Can you explain to our viewers and listeners what is the break-even market and what is it saying right now? Because it has to do with inflation.
Yes, it has to do with inflation, and it's a market measure. And it's not, what is inflation going to be in next month or the month after? That's not what the Federal Reserve really cares about. What they care about, the tenor or the time period that they care about, is around the 5-year point. And this is really important, Marianne, because if you were to just look at the soft data, particularly, I have a lot of friends that went to University of Michigan, but that University of Michigan survey is bonkers right now, right? It's showing inflation expectations a year ahead, 5 years ahead of 5% or something like that. That is not, as you mentioned, something that I think the Federal Reserve really cares about. The market measure, which are inflation break-evens, basically just measure what is the inflation rate going to be in 1 year or in 5 years. In 5 years, Marianne, that's been coming down. You're looking at something like 2 to 2.5%. By the way, 2% is the goal. So I think the soft data of asking people how do they feel looks pretty bad right now. And I think it might be related to who they voted for in November. Maybe not.
Maybe food prices.
Yeah, but the market data, such as inflation break-evens, as measured by financial instruments, are showing an inflation number that's a lot more tame, and that's something that we're paying attention to.
That's something we pay attention to, and right now it's a decent reading. It's not showing a lot of future high expectations, which was the problem we had in the 70s.
Exactly.
It wasn't just that there was inflation, but inflation expectations in the 70s basically got out of control.
Yeah, it became structural, not cyclical. And you could think about Japan, same sort of thing. They were stuck in decades of malaise because consumers believed that a good or a service in the future would just be less expensive.
Right, because they had the opposite, deflation.
They had the opposite. And what you're talking about in the 70s are U.S. consumers believing a good or a service in the future was going to be more expensive. And that's something that, is very, very serious to the Federal Reserve, and that's not happening right now.
So let's talk about the consumer.
Yeah.
The consumer in the U.S. makes up about 70% of our economic growth. As you know, the surveys are not showing a happy consumer. They're showing a very unhappy consumer. But yet we've had the CEO of Bank of America out saying, based on the data that they look at internally, that the consumer's still spending, that the first 2.5 months spending was up about 6.5%. Do you have an outlook for the consumer here? Yeah.
So first of all, I think the ultimate kind of confidence measure for a consumer is, does he or she believe that they have a job? And do they believe that their wage is going to outpace inflation? So if you just look at that, the truest measure, the unemployment rate, as I mentioned, closer to 4%, long-term average over 6%. We've had positive real wage growth for almost 2 years now in a row. So 24 months of payroll numbers. We get another one on Friday where wages have outpaced inflation. So I think that's important. I think consumers are worried about the effect of prices in the near term. But I don't mean to interrupt you, but we've recently had personal income data come out. Yeah. And personal income data is also going up. Yes. And one of the biggest signals that we've had on the consumer, Marianne, this whole post-COVID experience, particularly in 2023, when so many economists thought that that crazy tightening cycle from the Federal Reserve in 2022 was going to lead to recession, was just how interest rate insensitive the U.S. consumer continues to be. So what do I mean by that? 2/3 of a consumer's liabilities are his or her mortgage rate, okay? In 2020 or 2021, the 10-year note in 2020 got down to 48 basis points. Crazy. Now, you may have had to put a mask on. You may have had to have a Zoom with your mortgage broker, but you refinanced when rates were that low. In this country, we have the ability, any day we want, to refinance our mortgage. How do I know that? I know that because the effective mortgage rate in this country, the rate that people are actually paying, is still 4%. Marianne, 4%.
That's extraordinarily low. Relative to history?
Relative to history, when the Fed had a zero interest rate policy, that average effective mortgage rate was 4.25%. When the Fed took rates from 0 to 5.5% at the highs, that effective mortgage rate was still below when the Federal Reserve has zero interest rate policy. Why? Because this was such an unusual cycle because rates plummeted lower and then shot higher. But again, we have the ability, and that's different than a lot of countries. In places like Europe and places like Canada, you don't have the ability to refinance. Your mortgages are a lot more floating. There's a much cleaner transmission mechanism to what central banks are doing on policy rates to what happens to your mortgage rate. So I'm saying all of this because if 2/3 of an investor liability are their mortgage rate, their mortgage rates are, the effective mortgage rate is 4%. One of the trademarks and signals that we continue to believe is that the U.S. consumer has a very healthy consumer balance sheet. And if they were a CFO, they went into the office and refinanced their corporate balance sheet. So things like the high yields universe, things like the consumer balance sheet, very, very healthy versus what you would expect in a traditional cycle where the Federal Reserve took rates up this quickly.
That's a really good point. So where are you forecasting the labor market to go? I know there's a lot of uncertainty with Doge, but you seem to isolate. There's only maybe a few locations where we might.
Right now, we're only seeing that. Right. So we're predicting the unemployment rate similar to the Federal Reserve, not to stay at 4. So because of the the cooling that we expected in GDP. By the way, we were expecting cooling even if GDP was at 2.1. We expect the unemployment rate to be between 4.25% and 4.5% by the end of this year. And I think what that does, if you think about where the Federal Reserve's forecast is, it's right around that number. And then they're saying if the unemployment rate gets there, we're willing to do 2 interest rate cuts. Now, again, I don't want them to hurry up and ease policy. If they're doing that, something is broken. But if you're down this road of just cooling in the labor market that allows them to become less restrictive, because policy rates still are restrictive here, then you can slowly but surely get back down to that neutral rate, which we think this year means 2 interest rate cuts. So this is a normalization. 4% is not a normal unemployment rate. It's, the 50-year average is closer to 6. So if we get some cooling in the labor market, I think the Fed can come back in and make things a little better.
I was going to say, when I was an undergraduate student taking economics, the natural unemployment rate, because you have frictional unemployment, there's always people moving in the job market. The natural rate of unemployment at that time was considered 6%. So I'm fascinated that the 50-year average is 6%.
Where did you go to undergrad, by the way?
I went to Fordham University.
So did I, Marianne.
There we go. Go Rams. Go Rams.
Are they in the Final Four?
No. No, unfortunately, no. So let's get to portfolios.
Yes.
So we've covered all the macro. We have, so things don't look to be terrible. So 60-40, which traditionally means 60% equities, 40% fixed income. A couple of years ago, there was a big article that came out of a big bank saying 60-40 was dead. Meaning that the bond portfolio wasn't going to help you anymore. Well, I think the past year or so, bonds have actually done okay. So where are you with 60-40? Is 60-40 dead?
Yeah, so the answer unequivocally is no. Okay, so the Mark Twain quote, reports of my death have been greatly exaggerated, certainly fits into the 60-40. And I just want to touch on the 60 for a second as well. When we build client portfolios, what we tell clients is global diversification works.
Which most Americans don't do.
And most Americans, and it hasn't worked.
International clients do it.
Right, international clients do it. But we have a home country bias here.
Yes, we do.
For sure. And if, I've been waiting 8 years, Marianne, to come on something like this and say, wow, global diversification is working. That's how long it's been. Since 2017,
been a long time.
Since EFA, or developed non-US, has outperformed the US. And you're seeing it in spades in only the first quarter. One of the things that we write about in our long-term capital market assumptions is that the US has a higher valuation hurdle to get through over the next decade. US dollar is a little bit too expensive, based on the US exceptional that has taken over. What is the role of bonds in a portfolio? So I think what we're saying now is in the 60-40, you don't have to be overweight these parts of the world, but you got to include it in the starting point. Okay, so what does that mean? Our equity allocation has about 13% outside of the US in developed markets, EFA, and about 6% in emerging markets. That's the starting point. So when we're talking to clients just in the 60, 19% of the portfolio is outside of the US, and then the rest is in the US. So that's important. And then on the 40 side, the only way that the 60/40 would be broken is if you believed that bonds couldn't protect you, okay? And what we're seeing...
Because in most cases, you get your money back.
Yeah, in most cases, you get your money back. And in most cases, the relationship between stocks and bonds is when stocks go up, bonds may go down. Bonds go down, bonds go up, stocks may go down. So what we're seeing, what we measure on a weekly basis is what is the relationship between stocks and bonds? Correlation. How are they behaving? And this is the best diversification benefit for bonds in 3 years right now. It was 3 years ago, March of 2022, when the Federal Reserve started raising rates. And then it went really, really parabolic in 2022. Federal Reserve was hiking rates by 75
We basically went
basis
from
points a
zero
year.
to like five and
Yes,
a quarter.
exactly.
That was one of the
that.
fastest.
And the
rate
ag, if you
hikes
remember
in this-
that year, the ag was down 13%.
Yeah, that was
13%.
painful.
Worst year ever for bonds before that.
And stocks were down. So almost everything was down.
Marianne, people know what they're getting into with stocks, right? It's growth, it's recession, it's earnings. But nobody ever expects their bond portfolio to be down 13%. So what do people do? They ran into cash. And that's probably, collectively as an industry, one of the biggest challenges that we have is to get people out of money market.
There's
funds that are
about
sitting
$7
trillion in
trillion.
money market, all-time high. We've never seen anything like that. At a time when the Federal Reserve is bringing those rates down. But more importantly, there's no interest rate sensitivity in cash. So if you need the protection, let's just say NASDAQ is down. Stop the presses like it is so far this year. Bonds are up. And that's helping. So the 60/40 portfolio, we're myth busting here. 60/40 portfolio is not dead. And then also within fixed income, the credit allocation, I think, is really important. Corporate bonds, particularly high yield.
Considering that most businesses have a good balance sheet.
Exactly.
And even if we went into a recession,
Yeah.
we wouldn't expect many defaults, right? That's where people get concerned. Right. And you look at the high yield market for a risk proxy, and the spreads there seem to be pretty okay.
And I love that you said that as a risk proxy. It's the signal that high yield has given us. So like really anxiety-ridden events over the past couple of years. March of 2023, regional bank crisis. August of 2024, Japanese yen carry trade. In those two instances, if you look at the high yield market, you would have been, okay, we're going to get past this. The high yield market isn't telling us anything. So I think that risk proxy theme that you just mentioned, the signal that high yield is still giving us, even now, still points to an economy that's going to avoid recession. And if you look at spreads, I get the pushback all the time. Spreads are very tight, not compensating you for much. They're actually in their 10th percentile. So 90% of the time, spreads have been wider over the past 10 years, 20 years. However, the all-in yield, because treasury rates are above 4% on the 10-year part of the curve, 60th percentile. That's really important. So only 40% of the time over the past 20 years have you gotten a better yield than you're getting today. And we want it for the yield. We want it for the yield that we can get over and above what you can get in safe kind of treasuries or core bonds.
So for those clients that are sitting in cash, and especially if they had like 5.25, they're not going to get that when it matures.
No.
Not in the cash market. You can't find that.
Yeah.
So if you were building a portfolio today, what would you recommend that a client did with their cash? I mean, that's kind of open. You don't know their risk profile, right? Assuming kind of general risk.
Yeah.
Where are you telling people to put their money?
Yeah. So Marianne, this is really important because when that money market fund complex increased to 7 trillion, okay, there were 2 times when that 7 trillion jumped up, okay? The first time was in March of 2020 when, my kids were told to go home for 2 weeks and we'll see you in 2 weeks when this is all over, right? They were gone for the summer at that point. That was a very emotional time. So you have to think about, okay, is that truly a cash investor? Or is that an investor that's scared and doesn't know what to do? The second time that 7 trillion money market AUM jumped higher was at the end of 2022. 2022 was the first year, Marianne, since 1974 that stocks and bonds went down in the same calendar year. The reason why I'm bringing this up is there are cash investors out there. And congratulations, you're finally getting a yield. The Federal Reserve is not declaring war on the elderly and the savers of this country. But I can't believe, based on the 2 times that those things went up, that has not been an emotional investment. So what we're telling people is this isn't like sensational. Should you be in stocks or should you be in cash? Should you be in a thoughtful, diversified solution, balanced, 60-40 type solution, or should you be in cash? And the only reason why you would be in cash right now, instead of a thoughtful, balanced solution if you're not a cash investor, is if you thought inflation was spiking higher and bonds were going to go down again and 10-year rate was going 8%. That's the only reason why you should be in cash right now. So we're telling cash investors to get back into the diversified kind of balance.
And again, the key is diversification,
Yes.
right? So whether you're in your equity market, you want to be diversified between domestic and international is
Right.
what you're recommending.
Mm-hmm.
And in fixed income, there's many different pockets of fixed
Right.
income, whether you're in treasuries, in corporates,
And they all serve a different purpose. Yeah.
domestic, international. We didn't
Mm-hmm.
talk about international fixed income.
Yeah.
Are you finding anything in international fixed
You know,
income?
we had traveled in kind of the emerging market worlds in the past, particularly for our income mandates, Marianne, but we're really content with the high yield market for our extended credit as well as non-corporate credit and fixed income. Non-corporate credit are things like commercial mortgage-backed securities, asset-backed securities, as a way to diversify what we're getting on the corporate credit side. So finding managers that can take advantage of that, because there isn't that much of that stuff in the traditional Bloomberg aggregate index. So, you know, that active management within fixed income, particularly on the non-corporate credit side, is important, but not necessarily outside of the US because of all the opportunity that we're able to get here in the US.
So I'm not sure if you can talk about this,
Mhm.
but because we're talking about asset allocation, the other part that has gotten a lot of attention in the wealth management division is the private markets.
Yeah.
So there's equity private, there's credit private markets. Do you do any work in the private markets when you're building out asset allocation?
Yeah. So for our institutional clients that allow us to do it, where they don't need the daily NAV, we have carved out an opportunity for those alternatives. Private credit, private equity, and real estate. Direct real estate, we actually added so far this quarter because of the negative correlation that has with the 60-40. And
Again, the
the
diversification.
diversification benefit of it for sure. Yeah. And that's like a 15% allocation, Marianne, funded from fixed income. Whether you're talking about private credit or real estate, that's our funding source is the fixed income portion.
Okay, another one I just have to ask.
Please.
That comes under alternatives. Because private markets, they put that under alternatives.
Yep.
Gold keeps hitting, it feels like every day, a new record all-time high. The last I checked, it was just above 3,100. Do you ever look at gold in a portfolio, or do any of your clients ask you about putting gold in a portfolio?
Not necessarily do clients ask about it. I think they're asking about it more now because of how high the price is. But at the end of the day, we believe philosophically that treasuries over time provide the role of diversification versus something like gold.
And it gives you income, where gold does not give you income.
Gold, you're subject to prices going up, prices going down. Whereas the fixed income markets give you some sort of income. And again, the only reason why you would be buying gold at these prices versus diversifying through something like core bonds is if you thought inflation was spiraling higher. And we just don't have that view.
So let's switch to the equity market. There's a lot of different things in the equity market. There's large cap, there's small cap. We always hear about growth and value.
Yeah.
Just even a month and a half ago, all the talk was AI, artificial intelligence. They're talking about Bitcoin and the crypto space. So when you're allocating to the equity market, what are you recommending now?
So all large cap. And one of the things that we, and by the way, we came into the year with a little bit more mid cap in the portfolio. And I think
so you went down in cap. Mid cap is kind of between large cap and small cap. That's what some people call it, that sweet spot.
The sweet spot. And the reasoning behind that was it was trading at 17 times. Cheaper versus the S&P.
What was it,
trading
25?
21, yeah.
I think
the top 10 stocks were even higher, yeah. And then the other thing about mid-cap that was interesting to us was just the regional bank exposure. And that might come back. There's more financials in mid-cap that we liked.
Yeah, because as you go down in cap, you tend to have more financials in the index, right?
And that's a sector that we still like. I think that's still one that we like. But given the re-rating that we've seen, Marianne, do you realize that the Mag 6 are trading right now at 2017 levels versus the S&P 494?
They've come
We've
down
seen
a lot.
a tremendous repricing. So for clients that think they missed that, and AI isn't going anywhere. You mentioned AI, it's not going anywhere. Maybe it looks a little bit different, but now you have the sector on sale. And I think that's really important. So that's the US story, but we're neutral there. We're neutral there because of the uncertainty tariff that we mentioned. And we also are expressing it through high yields. But the non-US markets look a little bit more interesting to us today than they have in the past.
So when you're talking to clients, because you talk to a lot of clients, like what's the number one question that they're asking you?
It's fixed income. Fixed income has been treacherous. Like, what do I do with my bonds, and are they going to protect me? Because I think the scars of 2022, and by the way, most of 2023, we're still somewhat glaring.
Well, earlier this year in January, there was concern that 10-year treasuries were going to go to 5.25.
Yeah, and that the federal, we were like one inflation number away, Marianne, from pricing the Fed into tighten at some point this year. So we were still getting a lot of those questions, but it really has to do with what do I do with my bond portfolio? And then, Marianne, there are other clients that are asking, is this European thing for real? Because they've just been burned by it with these little fits and starts. But I can't stress enough just what an eye-opener the stimulus plan from Germany was that got released.
Oh, it's almost €1 trillion, if I recall correctly.
That got released in early March. And countries spend money a lot.
Not Germany.
Not Germany. They've been doing 100 years worth of austerity, right? So again, that's a valuation story. There was 20 years worth of bad news priced into non-US equity markets coming into this year. So in other words, a lot had to go wrong for that to make sense. So you get a little DeepSeek news, you get a little Chinese stimulus, you get German stimulus, and then all of a sudden that US exceptionalism shine starts to come off and valuations adjust. And you didn't have to be overweight that part of the world. Marianne, we're not coming in here and saying we were overweight Europe coming into this year. Nobody was. We had the US exceptionalism trade on, but we rebalanced and we made sure that even with our clients wanting this home country bias, as you mentioned, that we had at least index weighting in those markets, which has helped us this year. So, for the folks holding 7 stocks and thinking this is multi-asset diversification, they were in for a little bit of a rude awakening this year. For those that were, committed to both diversification within stocks as well as using bonds as a way to play defense, it's been a really, really good story so far.
So within our conversation, what I'm basically hearing from you is that there's still a lot of investment opportunities, even with talk of tariffs, even when you hear risk of a recession. It's a good time to sit down with your financial advisor, see how you're positioned, and see if it's a good time to rebalance your portfolio. That's essentially what I'm hearing from you.
And Marianne, the bond side, we think does play a role in terms of ballast and diversification. And that was an unknown for 2022 and 2023. And as you said, we were in this year, some people were thinking 10-year rates were going over 5 again. That's a really important tool for us as asset allocators. If we know that if stocks go down, because maybe we're wrong on the growth side, we're going to have bonds on the other side to protect us. I think that's another big deal. And that's different than cash. Cash doesn't protect you. Cash just gives you the rate, but it doesn't go up when stocks go down. And that's what bonds do.
So we've covered a lot in this conversation. Is there anything we didn't talk about that you think our viewers or listeners should be aware of?
No, I think what this cycle has proven, Marianne, is kind of expect the unexpected. It's just another Mark Twain quote. It's not what you don't know that gets you into trouble. It's what you absolutely know for sure that just ain't true. And I think the distraction, the noise around the tariff policy right now, and ignoring some of the stuff that people were really excited about coming into this year, I think is really kind of recency bias and kind of prisoner of the moment. So I would say stay big picture, right? Believe in the traditional relationships between stocks and bonds and provide enough staying power in the portfolio to plow through this period of uncertainty.
Well, Phil, this has just been such an informative and relevant conversation right now for people that are investing within the markets. I want to thank you so much for joining us here today.
My pleasure.
And I want to thank all of you for tuning in as well.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.
Securities offered through Sanctuary Securities, Inc., member FINRA SIPC. Advisory services offered through the SEC Registered Investment Advisors, Sanctuary Advisors LLC, and True Independence. Sanctuary Wealth consists of the wholly owned subsidiaries, Sanctuary Advisors LLC, Sanctuary Securities, Inc., and True Independence, as well as Sanctuary Alternative Holdings, Sanctuary Asset Management, Sanctuary Insurance Solutions, Sanctuary Global, and Sanctuary Global Family Office.